All right, thank you guys so much for joining. I am here today with Max Snyder from Prime Lending, talking about mortgage rates and why they're 8%, talking about how they correlate to the bond market and mortgage-backed securities. So, Max, thank you so much for joining me today, and we're going to dig right in. Uh, tell me a little bit about mortgage rates, why they're at 8%, and how we got here.
Yeah, for sure. Thanks, Tyler. Welcome to the home office. You see my world's okayest fantasy football player here. And as far as rates go, yes, we're depending on credit score and down payment percentage, people are seeing rates in the eights, which is not something they've been used to. This applies to both agents, especially newer ones to the business, but also seasoned agents for many years, and most importantly, all of our clients. Not just buyers too, the sellers, because it's affecting them and their perception of the market. So with regards to why they're here, how they got here, like we said, it's not uncommon to see rates in the eights, maybe the high sevens in the best case scenarios. And one of the table stakes for thinking about all this is inflation. So over the past several years, inflation has grown. And when you're thinking about mortgage rates at the base level, if we build up in this discussion, at the base level, inflation has the strongest correlation to mortgage rates. And that is because mortgages have fixed rates, like we're all aware of, and the big power money, big player monies that be on Wall Street, et cetera, who invest in these sorts of securities, they're expecting a fixed return over time. And because of the uncertainty surrounding inflation, price of things goes up, or the value of the dollar decreases relatively, that return becomes worth less over time. So they're baking that risk into these rates and the demand for higher rates. And that's why we've seen that. Another kind of base level of knowledge building block is the reason that you so often hear the 10-year treasury compared to the 30-year fixed mortgage is because most mortgages get refinanced, sold, prepaid, defaulted on in that 7 to 10-year time range. So it's the same types of investors buying them and the same terms. That's why people are comparing the spread between those two things. And because so many more people buy treasuries and they're perceived as guaranteed by the US government, people follow that 10-year treasury as an indicator of what the 30-year fixed mortgage-backed security is going to do.
Now, that spread has increased, whether I use the term artificially inflates rates, but that spread has increased over the past 10, 15 years, correct?
Correct, yeah. And we may have to adjust, we may have to accept that the norm for the spread is going to be different. But when Tyler says spread, it's simply the difference between the yield on the 10-year treasury and the rate that you see on your 30-year fixed mortgage. So for example, historically, the spread has been 1.5% to 1.75% difference. So if a 10-year fixed treasury was 3%, for example, your 30-year mortgage-backed security might be 4.5 to 4.75%. Because of the uncertainty and the risk, that spread has widened closer to like 2.5, 3% lately. Some of the reasons are a lot of those investors I talked about a second ago are anticipating that many borrowers will refinance before it ever reaches that 7 to 10-year maturity. So they're baking in needing a lot of their returns up front. Combined with all the other risks associated with a mortgage being paid back that don't apply to a 10-year treasury. So that spread has grown. And the last thing that often goes untalked about because it's not as well understood is that in COVID, the Federal Reserve was actually to stimulate the economy and to drive rates lower. They can only go so low after you have the Fed funds rate, the borrowing rate between banks at 0%. They were actually buying, added demand, economics 101, to the market for mortgage-backed securities. So they actually started buying more and were a major player in terms of buying, which drove the prices of mortgage-backed securities up, and as a result, the rates down. Now, since then, in more recent months, they've not only stopped doing that, but they're letting some of these maturing mortgage-backed securities roll off of their balance sheet. And again, economics 101, now that they're no longer a buyer at the scale that they were, less buyers means higher prices. And as those prices of mortgage-backed securities have gone up, lower prices, less buyers mean lower prices. And as those prices have gone down, the rates associated with them being demanded by the remaining buyers have gone up.
Yeah, it's more appealing for them to obviously have a larger spread.
Yeah.
So one thing that I like to, and I appreciate the insight, because I think a lot of agents don't know how all this works in the background. And when we get things that say, oh, the bond market's doing this, we don't know what to do with that information. So I think this is greatly helpful to those that are more interested in finding out, how this does work. One thing that you mentioned was the supply and demand during COVID and what that did. And we know that home builders from 2008 to 2014 really weren't doing much, if anything at all. We had a huge supply and demand issue on the actual inventory side. When you have the perfect storm of these rock bottom interest rates and no houses available for the millions of people that want to buy them every year, it creates this perfect storm that we were in and we are still in and feeling the effects of. Because, last I heard, it was going to take 5 or 6 years to catch up with the housing demand. And that's why we're seeing interest rates where we're at now. One thing I would keep in mind to advise your buyers is that, hey, we had 3%, we had 5%, we have 7%, we have 8%. It's not going to be forever. The typical, and you said 7 to 10 years, those correlate. Latest data that I've seen actually shows a little bit faster. It's closer to 5 to 7. So that interest rate certainly is not going to be forever, but also keep in mind there are 4 million people every year, 400 plus, not 400, 4 plus million people every year that have to buy or sell. Whether it's a new job and a relocation, whether it's a divorce, whether it's a death in the family, there are still millions of home buyers and sellers every single year. And who's going to be the agent that's there to help them? I know you use the analogy and I'll let you finish it, but we're all playing the same game. We're all here working and have the same level playing field with these interest rates. But as you said, we've actually recorded this 2 other times, but didn't record it. As you said, the playing field's level, but somebody just introduced a new rule and we're all playing by this new rule, which is 8% interest rates. So the question is, are we going to see 6? Are we going to see 5? What does the time frame look like on that?
100%. Yeah, it's a new playing field. We all have to deal with the same thing. And this should impart confidence to you as the agent. If you're just a little bit, you don't have to study it every day, a little bit more educated than everybody else who's saying, I don't know. They're just leaving it at that. We're not trying to act like we have a total crystal ball. But with regards to crystal balls in the future and will things get back to 5 or 6, economists at the start of this year from many of the organizations we recognize, Freddie Mac, NAR, they were telling us, hey, by the end of this year, maybe next year, we'll see, down closer to 5, 6s. And now those timelines have gone farther out. Most of them are indicating that it's probably not until the year 2025 that we might see some sort of consistent decline. I don't think 5% is out of the picture, but all the reasons aforementioned of why things got down to 2 and 3 have a lot less likelihood of returning. So rates will go lower. There are opportunities and reasons. It's worth educating your clients on that. Future potential refinances, how it affects sellers, how it affects people who are waiting to get into the market at a certain point or list their home. But again, it's probably going to be a little longer. We're all dealing with the same thing. There's actually some data that says there's more anticipated mortgage purchase applications coming next year versus this year. So I think there's still a ton of opportunity.
Yeah, the demand is not going away. The builders are still not caught up. That's not going to be solved for years from now. The interest rates are, we'll call it a hiccup. It may have affected somebody's debt to income ratio or their purchasing power, but people still need to move. And so, like I said, we've got to be there ready to help them and understand too that with that demand, if interest rates do magically go back to 5 overnight, that demand's going to double. And we're going to have an even larger problem. Back to multiple offers within 24 hours, 57 showings in one day, those kind of things. So we take the market in stride, and you just got to be ready for it, ready to adapt. So, Max, thank you so much for joining me. Even though it took us multiple takes, we'll definitely have you on again because you're a wealth of information, and I hope the agents learned something from you today.
Thanks, Tyler. I appreciate it.
Talk to you soon.